And let's start with the comparison with the age-old chicken and the egg. Like, do you need the deal first or do you need the money raised first? And I don't think either one of those is the wrong answer. And I'll tell you how I've generally approached it. And what I found is that when you find a good deal, you'll be able to find investors. With almost every deal I've done, I focused on the deal funnel and the acquisitions first to lock up a good deal, and then transition to raising the money for that deal once I had it under contract. And I haven't yet failed to raise the money. And I think necessity breeds invention. And when I've needed to get it done, I've gotten it done. And maybe it took 10 or 50 more phone calls than I thought it would. But that can be the reality when you're raising money, especially when you're first getting started with it. And there are so many people out there who just raise money for deals now that once you find a good deal, you can take it to one of those people and have them raise the money for you and for a split of the GP and get them incorporated in the deal. And here's the nuanced answer. I think you should do both at the same time. Look for deals and look for investors. Like if you have partners, or if you're a couple team doing this together, you can divide and conquer those responsibilities. One focus on deal funnel, one focus on investors. And if you're currently solo doing this, carve out time in your schedule for both of those. It's like schedule time to look at online listings and call brokers, and also schedule time to network and have discovery calls with the potential investors. As an entrepreneur, you should always be networking anyway and putting it out there about what you are looking for. It takes massive action, but it's really not rocket science. Like if you want it to be easy, you can always go back to looking at houses instead. But I think you're here in this program because you want to go bigger, and this is just part of it. It's like putting in the work to find all the capital that you'll need. Now, raising capital is a whole area of expertise as a subject area, but you don't have to be an expert to raise capital. But you do need to get a firm understanding of it because eventually you'll need it. Because capital in the form of money you're able to raise is going to be your ultimate limiting factor to your growth. You can have all the lender relationships willing to lend you money and all the deals in the world and the ability to run and manage those deals, but without the capital to fund them, you're going to be stuck. And boutique hotels are bigger deals with higher purchase prices, so if you want to scale, eventually you're going to have to raise capital. Let's talk about how you can find investors to invest in your deals. I think the first and the easiest and probably most obvious is friends and family. Like who do you know in your immediate network of your friends, of your family members who might have the available capital, who can invest in your deals? These are going to be the people that already know, like, and trust you. And by showing them what you're doing, they have that innate trust in you. Take it to those people immediately around you. Maybe it's your mastermind members, maybe it's people that you met at a conference. Like the people that already know you are going to be the best source, like friends and family. And to connect with more investors, you can go to local events and tell people what you do. And it's a great way to meet new people, like real estate meetups and conferences. Local entrepreneur or business organizations is get out there, put yourself in new situations, meet new people, make new connections, and just always be telling people like, hey, I'll buy real estate. We bring in passive investors to help us scale a portfolio. And then it's like, just starts the conversation like, oh, what's that look like? You bring in passive investors, you're raising money, blah, 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 blah. It's like, yeah, we're looking to raise money, or we just completed a raise. Do you know anybody who might be interested? Or maybe they say they're interested. It just creates the avenue for more people to come into your investor funnel, of leads who might be able to invest in your deals. And then on social media, like talking about your deals and presenting the opportunity for future deals too. Like, I don't think there's a better place in the world to raise money by just putting it out there what you do. Like, you have to let people know what you do and what you're looking for. And social media allows you to get in front of masses with both of those things. You have to be careful of like SEC rules in most cases because you can't openly advertise unless you do a 506c raise. But you can set the stage and use social media to connect with new people and make new relationships with potential investors. And this is how I've gotten a lot of people to invest in my deals. They see me doing stuff online or on Instagram, Facebook, whatever it is, just sharing deal progresses. It could be as simple as going in and walking through capturing some of the project and the updates and saying, hey, we're looking to do more deals like this. If you want to invest, hit me up. Like just last week, somebody sent me a message on Facebook Messenger. It was like, hey, I saw one of your posts about passive investors. Can we jump on a call? I've got some money. I want to place, just sold a business. So it's like you don't get that flow of investors to you if you don't put it out there. So social media is a great way to do that. Also, you can ask friends and other investors for referrals of people who are looking to invest in the deal if you have a current deal. I had my first syndication. I think one or two of the investors that invested with me came from a buddy who also raised money and did deals and stuff like that, but they didn't have anything in the pipeline. And, you know, from start to finish, that's like a 90-day minimum process. So it wasn't hurting them. But it's, again, it's all relationship based. If you treat people well, if you know, are a good friend to other people and do them favors, they'll do you favors like that as well. So just simply ask, like, hey, anybody in your network, do you know anybody who's investing or wants to invest? And create that referral and give a warm intro. And then it's not like you reaching out in the DMs like, hey, you want to invest in my deal? It's more warm with that referral. And you can also build your own email list of potential investors by lead magnets on your social media, on your website, whatever that looks like. And what that is, lead magnet is essentially like a free piece of value. Maybe it's an ebook, maybe it's a free analyzer, maybe it's your top tips for passive investors, or hey, this is, you know, our top 3 things for boutique hotels and investing in them or maybe it's the short-term rental space. And that's like free value to your potential investor base or to your audience that you already have on the platforms that are engaging with your stuff. And if you put it out there for them, they download it, they have to put in their name and their email address. And then that, you know, you can put that into your CRM and start sending them emails, keeping them updated with what you're doing, and then get those extra touch points that it takes for somebody to build trust with you, get to know you better, and get to like you better, like the know, like, and trust triangle. That's what it all comes down to when you're raising money. Gives you more touch points, and then you can also, like, as that list gets bigger and you get a deal, these are people you have relationships with and can send it out, you know, to that list and say, hey, we've got a new deal. Let me know if you want to invest. And that's how the big guys that raise a bunch of capital, they've got massive email lists that they're able to send out a blast. And then because people know, like, and trust them, they'll get a deal fully subscribed just by sending out an email or sending out a text blast. All right, this one's gonna sound overly simplified, but literally go through your phone into your contacts and then reconnect with people you haven't talked to in a long time and update them on what you're doing. A little ninja trick here is for more like deferential people or, you know, people who haven't raised capital before, is ask them if they know anyone that's looking to invest passively in deals. It eliminates the direct ask and allows them to easily say no without rejecting you. And then it gives them the opportunity to refer another investor and even give you an intro and set up the stage for you, like that warm introduction. And it's just so simple. Like when I was going through my raise, it was like, all right, who could I connect with? Who have I talked to about real estate? Who have I, you know, who's it been a long time that I connected with? It might be a potential investor. Like you guys have your first list in your phone, right? So utilize that and don't overcomplicate it like you got to do all these things. Just reach out to the people that you know. And another one is the people you work with or the people in your career field. And this one has been huge for me. Like my first big raise for the apartment syndication I did was a 506B raise. And 6 out of the 7 people who invested with me were military. And then 5 out of those 6 were academy grads. So it's like, you know, that common ground with people. And then it leads into the next one. That's alumni groups, like people with similar experience and a background. They're going to have a higher innate trust level with you. And both of the last 2 that I mentioned, they're people that are involved or have the same activities or the organizations as you, have an easier threshold to build trust with you, and it's easier to get them to know you because you have that common ground, and they are more likely to like you because you are alike to them. And that's the know, like, and trust triangle. Like that is how you do it. So, you know, maybe you come from a nursing industry and you could reach out to all the nurses that you worked with, or you could, you know, create a brand around connecting with nurses online, or maybe like for me, that's Air Force people. So I can connect with military people. I connect with people that are in the Air Force. So it gives me a broader thing. And then I could, you know, even narrow that down to people that went to the academy, which is a handful of people that invested with me. So I've got those 3 kind of tiers of my niche of people that I more easily connect with. And that's going to be different for you based on your own situation, you know, background, prior career, whatever it is. But a great, great way because you already have a foundational relationship with these people based on the common ground. So reach out to those people. And then the last one is, we talked about it on finding deals as well, and it's the same with getting investors, but tell everyone what you are looking for and what you do. Like when you meet people, it should be like a little elevator pitch of, yeah, you know, I invest in boutique hotels, scaled up from short-term rentals, and now we're raising money from passive investors to do these bigger projects, providing these awesome returns, and creating these awesome, unique spaces with amenities and limited service hotel. Like it's a really good strategy. And then you're, you know, excited about it. You're warm. It gives you something to talk about with them. And, you know, a percentage of those people will end up being like, yeah, tell me more about that. Like I, you know, want to invest. But the more people you let know what you actually do and what you're looking for, like you got to put it out there to the universe to get it back. And just like I said with the deals, the more you do this, you'll be so surprised of who from your network gives a referral. Like it might be a friend that refers another friend and is like, hey, you need to invest with this person. They're doing some awesome things. Or maybe somebody hits you up on social media. It's like, hey, I saw your post the other day. I want to invest with you. And that's just how it goes. You just scale that and try to create a system around it so you can kind of capture those. And then you're off and running to being a legit capital raiser. But I think overall, you can seriously find investors anywhere. I know people who have talked to the person next to them on a flight and then hit it off and got to know them, and then that person ended up investing in their deal. So your job is to always have your radar on, tell people what you do, and then when you have that conversation with them, present it as an opportunity. And remember, you're not asking for money. That makes you look needy, and like no investor wants to give money to a needy person, right? But when you present yourself as someone who knows their shit and has a great deal, and you offer the opportunity for them to invest in it, it shifts the power balance and puts you in demand with them. And it takes the pressure off of saying, will you invest with me? So that's how you go about it, is present the opportunity. Now that's where you find investors, but there's more to how you technically complete a raise. And now we're going to talk about a couple of the most common ways to raise money from private investors to fund your real estate deals. And these are our 506B offerings and 506C offerings, partnerships, and debt raises. And before we get into that, the 506B and 506C raises, which are the most common way to raise a lot of money from a lot of investors, it's important to understand how both of those work because they're both SEC regulations and exemptions to that, exemptions to having an IPO that you take on the open market. And they both fall under Regulation D or Reg D of the Securities and Exchange Commission, which governs private placement exemptions. And you'll hear private placement exemption more as you get into this because all the raises will have a private placement memorandum or PPM that outlines the risks for investors and is more diligent on behalf of the investor since it's not an investment available on the open market. So just something to be aware of there. And a private placement is a sale of stock or shares or bonds to pre-select investors and institutions rather than publicly on the open markets, like an alternative to the IPO for a company seeking to raise capital for expansion. And when you raise money like this, your investors will get shares in the real estate that's purchased, and the regulation allows you to raise the capital through the sale of equity or debt securities, which will secure that investor's interest in the deal without your need to register those securities with the SEC. So it's way cheaper and way less compliance than going public, obviously here. And one of the few ways that makes sense to raise money for private real estate deals. So getting into it, 506B. So under Rule 506B, think B for Buddy, and you'll see why, is companies conducting an offering can raise an unlimited amount of money and can sell securities to an unlimited number of accredited investors. And under a 506B, you are subject to the following requirements. You cannot advertise or solicit the deal, and you can't raise money from more than 35 non-accredited investors. And then all of the non-accredited investors must meet the legal standard of having sufficient knowledge and experience in financial and business matters of what they usually call sophisticated investors, so that they can evaluate the risks and the merits of the potential investment. And then 506C is functionally the same with a few key exceptions. It permits issuers to broadly solicit and advertise an offering, provided that all purchasers in the offering are accredited investors, and also that the person raising money or the issuer takes steps to reasonably verify the accredited investor status and certain other conditions of that people. So you have to make sure that they're actually accredited to be able to advertise and then get them in your deal. So 506B and 506C exemptions are both about the same price for a real estate attorney to draft up. They're like in the $20,000 to $25,000 range. They're just fundamentally different in the rules for accredited versus non-accredited investors, and that you can advertise or not advertise. 506B raise usually makes much more sense when you start out, because you can discuss it with your network and pull people in who are non-accredited investors, which for most will increase the pool of potential investors that you know and can talk to. While a 506C raise, they're much better for scale, once you have an established track record and can effectively advertise on social media or wherever, but it's only for accredited investors. And it makes sense because, I'm sure you can imagine a great advertisement offering fantastic returns that attracts in a lot of non-accredited investors, right? Who may not otherwise know and not know the risk and the capital that they're putting in, and just be less diligent with their decisions. And then to be an accredited investor means you make more money, you have a higher net worth, which generally tracks to that you know more about how to make and manage money and then make investment decisions. And so you can advertise to those people. So that's the difference. 506C can advertise, but accredited only. And 506B cannot advertise, but you can get in non-accredited investors. So knowing the difference of those, that's what you want to kind of set up when you're syndicating, and this is to the deal. You syndicate based on that deal, and your 506B raise or your 506C raise will be tied to that single real estate deal. And the next deal you do can be different, or it can be the same, or a completely different structure. So important to kind of understand that as we go forward. So we talked about syndicating via a 506B and a 506C exemptions to offering security. But those can be expensive and a headache to get set up and managed, because you'll definitely need an investor portal and increased accounting and reporting. And if you can raise all the capital needed from just a few investors, then you can be clear of having to go through that whole mess and structure it as a partnership instead of a syndication. It's going to be around $10K cheaper or more for your attorney to draft up a partnership in an operating agreement than it will be for like a 506B or 506C exemption and the PPM and everything else that goes along with the syndication. And in a partnership, you and your attorney will outline the responsibilities of each party and who has the voting rights or who the managers versus the members are. And it's a great way to do a deal to make it simple and faster, more fast than going through the SEC exemption route with the 506B or 506C. Now with a partnership, you're going to be limited to around 5 or 6 investors. That's because, again, once you get more than that, it borders on providing a security, in which case you need to structure one of the exemptions to offering a security that we just talked about. And it's much faster and easier because all you need to do is the operating agreement and outline your responsibilities as the manager and make sure that that protects the members or the investors' interest in the deal. So your paperwork's less, attorney costs, all of that. And with a partnership, you can also buy multiple deals and package them together. That's what I did with 3 of our hotels. They were all under one PropCo entity, like the HoldCo, that then each owned each LLC or PropCo entity. So you can do these complex structures in a simplified fashion if you can get the money from a few individuals. So it makes your capital raise easier, your deal structure, right? And you can just go through due diligence a little easier. Now, what you also have the ability to do is to start a fund. And a fund allows you to pool money to buy more than one deal when you get to that point. Like where a syndication is tied to a single property, and each property you buy would require you to do a separate syndication. A fund allows you to raise once and then buy multiple properties that meet the requirements that you outline as the target of that fund. So a private fund is an entity created basically to pool money from multiple investors that is not required to be registered or regulated as an investment company, which is good for you. And as you seek capital for your fund, keep in mind that your fundraise will be subject to the federal and state securities laws that you'll be raising, because you'll be raising capital from investors through the exempt offerings, which means that any offering must fall within an exemption registration under Rule 506B or 506C or something like that, under Reg D, which we talked about. And the documentation is going to include an offering document, the PPM, that acts as a detailed disclosure for the potential investors, and a subscription agreement through which the investors contract in the private fund in the first place. And the funds do require legal formation, and most are limited partnerships, in which case those partnerships will have a general partner and will have a limited partner, like we talked about your structure through GP and your LP split. So the structure is the same, and it gives you a lot of flexibility to raise money into this pool and then buy deals as you're filling up the fund, and make strong offers on properties too, because as the fund continues to rise, you can take down the bigger deals and have you could say they want $2 million, or you can say, all right, we get $2 million cash and refinance that when we refill up the fund and go buy the next deal. So it just gives you strength in the position as a buyer. And this information serves to add a tool to your tool belt so that you know your options and can structure the deal and the entity and then source the funds in the best way that suits you. With transparency, I have not yet done a fund, but after the current deal I'm working on, I think that's going to be the next step. And then, I'll go through the steps and work with my attorney to set it up and draft the PPM, the subscription agreement, and then start raising money to that fund and go take down bigger deals. So it's not that complicated once you grasp the theory behind it, right? Because your attorney is the expert who sets all this up, makes it legally binding. So you just get a good attorney who knows how to structure real estate deals like this. I have mine, and that's a resource for you guys. Worked with other ones. So however I can patch you guys into that, let me know. But the thing is, just don't overcomplicate it, right? That's why you hire the professionals. That's why it takes, $20,000 to $25,000 to set one of these up, because it's complicated. It takes that person to do it. And you just need to know really big picture how it all works, be able to explain it to investors and which route to pursue based on what works best for you. So that is how we're, bringing in deal structuring as far as the course is concerned. I wanted to make you guys aware of these things so you can incorporate it into your business. If you guys got questions, let's talk about them in the community, or when we meet. Want to be able to answer what I can for you guys based on the deals that I've done, how I've structured mine, and can kind of guide you guys through that. So we talked about raising money and structuring deals, and the other piece of your capital stack, the debt, is really important because it often dictates where you bring in the equity from or how you structure your deal with the investors. And getting good debt is obviously super important, because if you buy wrong by paying too much or have bad debt, you may either miss the equity in the deal by not being able to buy it in the first place, or worse, losing the property because you had a bad capital stack. And I think bad debt, like in my opinion, is primarily variable rate with a short-term balloon payment where, your note comes due in 12 to 24 months before you might be able to get the property properly stabilized. And when that rate goes up, it could kill your deal, or when your note comes due, it could be taken back by the bank. So how you finance your deal is really important to make sure you can weather it and kind of implement your business plan with the deal. And there's two parts that I want to break down for you: the purchase and the refinance. Because in order to create a lot of value, there has to be a spread of what the property is worth when you buy it and what you can get it, like what it can be worth when you get it completely fixed up and then season the property, or if, essentially have it done and renting for 12 months. So you're likely going to refinance instead of selling, so you can hold the property long-term, keep cash flowing and benefit from the future depreciation and the tax write-offs and the appreciation over time. Like, that's the name of the game with real estate. So ideally you want to hold on to it. That's how I've done all my boutique hotel deals. They're basically big BRRRR deals, or BRRRR B&Bs. And the first step with this is getting financing you can live with up front. And I say it like that, financing you can live with up front, because most of these kinds of properties are not your sparkling gems going in. Like, they need you to make them shine. They need the value add component. Like, they have poor financials, if any at all. Like, once I got one, it's just numbers on a piece of grid paper. So it takes some work to get financing sometimes. That's because bank want to see things like financials and loss runs for insurance and just basic due diligence items. And some of these hotels run completely independent without much or any of that, because they're mom and pop operators that don't need to do anything more because they don't have bank loans or investors. They just do their thing, which is great for them. But with that type of property and financial condition, it makes it tough to get financing. So here's some options for you to pursue financing for boutique hotels once you get in that spot of finding your deal. One of them is bridge debt or mezzanine debt, which is a short-term money that's more flexible, but you usually pay for it in fees and interest. And they have a lot of flexibility with the condition of the properties going in and the due diligence items that are required to get the deal. And they'll basically lend conservatively off your strength as a buyer and the strength and the upside of the deal based on your pro forma. So if you can draft a good pro forma, present yourself professionally, and get it in these banks' hands and create that relationship with them, it can be a really good option for you to have some flexible financing to buy a deal that otherwise couldn't get debt on it. And another one is institutional hard money. It's basically bridge debt with specialized lenders for commercial real estate. So you'll see these loan products typically for different asset classes. Like, you might have an institutional hard money lender that does a portfolio of homes. They do commercial multifamily, but a lot of them unknowingly have like carve outs for different asset classes. So they might have 10, 15, maybe only 5 of their portfolio that goes to hospitality every year. So if you can find that lender and they'll provide you the debt, it just gives you another option of something that is more flexible. Yes, it'll be expensive and shorter term, but getting the deal, as long as it still pencils with that debt, doesn't really matter if it's 11-12% with a couple points, if it gets you the deal and the numbers work. And I've used two different kinds of these lenders, from institutional hard money to that bridge debt product for the commercial space. And those are in the resources, so you guys can go to see them and pull that when you're ready for your deal. And also there's commercial loans with local banks or credit unions. And these are going to be, they'll have flexibilities of their own as well, because that loan is going through a local lender. So it's going to be largely based on your relationship with them, and then it's probably going to go through a committee at that bank as well. So if you can present yourself in a good way, make a good relationship, a good impression by presenting yourself professionally, you're going to have a really good chance, especially if the deal pencils, and making sure that you can hit the DSCR. But yeah, local banks and credit unions, that's how I got my start in the hospitality space, lending on short-term rentals, and then underwriting the hotels, whether there's purchase or refinance. It can be great options, and they want to lend in that market, right? And they already are familiar with it. They probably have a gauge of the demand and the financials and that kind of stuff, or maybe even know the owner. So they can be great sources for you for funding when you're buying a deal. And also the SBA has an option for SBA-backed loans. And they have loan-to-cost loans too, where they'll actually lend on both the purchase price and the repairs. Like for a normal loan that's loan to value or LTV, on a $1 million purchase, you're going to have to bring 25% down or $250K. And with a loan that's loan to cost, if you have $1 million purchase price and $500,000 in repairs, they'll lend 75% on that $1.5 million, including the purchase and the repairs. So it helps keep your capital required lower and your cash on cash higher. But keep in mind, it's SBA, it's government, it can be very bureaucratic and very long, and it's not actually the SBA lending on the deal. It's typically a local bank with a percentage of that loan backed by the SBA. So the SBA is guaranteeing that loan if you default, so that's why local banks will do it. And you want to find a local bank that specializes in SBA loans, because not everyone can do it, right? You don't want to get down in due diligence and be 60 days in and then they back out because they really don't know the process. But can be a great option, right? They are meant, like the SBA is meant to provide small businesses opportunities. Just be ready for the red tape and the hoops to jump through, but can be a good option for you. All right, and then my favorite is seller financing. So I've done this on 2 of my hotels and then other deals before that. So I love this strategy when I can implement it. I've probably offered on it on almost every deal I've done. And with seller financing, you avoid needing the bank at all, which is great for you and for the seller, because like we talked about, banks want to see financials and take a long time to underwrite, and they can hold up closing for a long time. And you can skip all that if the seller agrees to carry the note and be the bank themselves. And like we talked about in the last module, it can be good for them based on their situation, because they can get interest on their loan, and that interest is tax deductible. And then the taxes on the sale are deferred because the whole amount of the sale is not earned on one purchase. So it spreads out their tax burden and can get the deal done quickly for them if that's important to them. And since we've already dove into the strategy of seller financing, I thought it would be good to go over some discussion and negotiation points to bring up seller financing to help you get more. So the best way to gauge if it's going to be an option is ask, what do you still owe on the property? That's to see if the seller will be, to see if it's even feasible. Like if they still owe a bunch of money on it over what you could do as a down payment to pay off the loan that they have, then it probably, isn't worth the seller financing. And you can ask, what do you plan to do with the cash from the sale? Or something like, is there something else that you'd be buying once you close? Something along those lines. And that's to see if they have a need for that cash. So first you want to identify if it's even available based on if they have debt on it or not. And then 2, if they have plans to use that cash. And if both of those are no, kind of tease up a good negotiation point for you to drive home the seller financing. And with all this stuff, when you're dealing directly with sellers, it's all about how you ask, right? So make it conversational and not like you're trying to extract information out of them and just pluck it out. They are going to want to be comfortable with you to seller finance. So keep that in mind when you're having these discussions. And another one is ask them, if we could structure the sale to keep some income coming in for you, would that be of interest, or would you rather just have the cash but no monthly income? And the goal here is to see if the income from the monthly payments would be important to them or something that you could leverage. And you can structure that question however you want to get that answer. If they would be interested in the income, in those payments, then you talk about the benefits of the seller financing them to them and explain that to capitalize on this point you're trying to make. And if you sense that taxes may be an issue, then you could say something like, since you don't owe anything on the property, or if you don't owe anything on the property, we could structure payments so that you get your price plus interest, but it's spread out so that you aren't taxed for the full amount up front and you'll save a lot in taxes. So appeal to that. And if they're a straight shooter, you can come right out and ask, like, would you be willing to carry the note and finance the purchase if I can give you some money down and then structure in a good monthly payment for you? And then we'll do a balloon in a couple years so that you get paid in full with your interest. And these are all just conversation starters to get that ball rolling with seller financing. The key is to ask a lot of genuine questions as you build rapport with the seller and get a good idea for what their situation is and how seller financing may help them, because it's probably going to be good for you. So all the financing options I just described explain the debt portion of your capital stack. And the capital stack is just the organization of the capital or the money in your deal. And all of these, with the exception of 0% down seller financing, require a down payment. And that is the equity piece of your capital stack, that and the repairs and reserves and everything else you'd have to bring to the deal. This is the money you either need to bring yourself or raise from investors. So just wanted to kind of clarify how that capital stack works if you don't have experience raising money and structuring deals like this. And in order to be prepared for lending, you need to get your ducks in a row and prepare yourself to be lendable by getting all the documents together that a lender is going to need. And generally speaking, what that lender is going to want to see is, first of all, your personal financial statement, or PFS, which is basically a snapshot of your personal financial position, and it lists your assets, like what you own, your liabilities, which is what you owe, and then your net worth. And also is your statement of real estate owned, or your SREO, which is exactly what it sounds like. It's a form that lists all the properties that you have full or partial interest in, along with the current market values and corresponding debt obligations or mortgage balances. And then usually they're going to want to see your last 3 years of tax returns. And most of the time this will be your personal return, or 1040, where all of your real estate and other businesses flows through. Then if you have K1s from other deals you're in, they may want to see those too. And then any partnership returns that you may have. And they'll also want to see your pro forma and your scope of work for any renovations. And then things that make you look really professional and good in the eyes of the banks are things like your organizational chart, like details of your company, like what you do and why you're good at it, a financial overview of your company, and your business plan for the property, like what you plan to do with it and what your and how your vision for it fits your company's competencies that you share in those other documents. And all that stuff is in the resources folder, so you guys can go check that out and see how to build a really good deal package along with your own PFS and statement of real estate owned that you can provide to the lenders when you get to that point. But it's good to start to gather this stuff together so that you're ready. And if you present all this well and quickly to the lender too, that's a big thing. They're gonna be impressed. Like most people or businesses that banks lend money to do not have their stuff together like this, and don't provide them with all the relevant information, the details about the company, so that they can see the strengths and the operational experience. But you're gonna do that, and then you're gonna set yourself a league above. It'll make even more of a difference if this is a local bank with like a small loan committee where they actually meet and discuss your loan and vote on it, which is pretty normal for a lot of small banks and credit unions, because then it's going to spread through like how professional you are and how well put together you guys' package is. All right, and then once you purchase the property, you fix it up and improve the value and income, you'll likely want to refinance and complete the BRRRR process to get your money out and tax-free, because refinances are non-taxable. And then you go buy the next property. And that's how you really scale, is by going through this process really efficiently like that. Buy, rehab, renovate, refinance, repeat. And now when you go to refinance the property, you'll be looking at slightly different financing options, but usually much better terms for you now that you're able to hold for the long term because it's stabilized. And some are the same, but with different terms that will be more favorable to you by this time, because you're seasoned, you got the 12 months of operating experience and financials, and you're good to go on a financial side. And if you don't have your property seasoned yet, you can go do another bridge loan and refinance your purchase financing to bridge debt for another 12 to 24 months. If your project is done, you should be fairly confident that 12 months you'll be able to be in a better spot to refinance, so it's not that crazy to take on the bridge debt. That's going to allow you to capture some of the equity created and pay off the principal of your investors and just return some of their capital and yours while you continue to hold for the cash flow, like maybe some reserves that you need. But be careful, because you don't want to put yourself in a spot where you have bad debt, right? Like your goal should be long-term fixed rate debt, or at least a period of 5 years at a decent interest rate where you can pull out some of the equity tax-free and continue to hold. But if you get into this short-term debt that's high rate, short-term, just be careful with that. All right, and getting into your refinance options, back to the local banks and the credit unions. Like, no one's going to have more faith in your property than a local lender. Like, they know the local area and the market forces and have quotas of loans that they need to give. Like, they usually have a percentage of their portfolio that they have to put into different asset classes based on their bank charter. And your goal here is to build relationships with these lenders so that they can be your go-to and give you the best terms deal after deal, or at least if this is your first one, give you good terms on that one. And then the SBA, again, like more hoops to jump through and it's a longer process, but still it's a good funding option. And it's not the SBA, like we talked about, actually lending, but the SBA working in partnership with approved lending partners, like including your national local banks, that guarantees a portion of the loan's proceeds in the event that the borrower defaults. Like, this is the arrangement that allows these lenders to approve funding for small businesses who may not otherwise qualify due to the relatively high risk involved in small business lending. And, as a boutique hotel operator, that is your small business. And then sometimes you just have to pick up the phone and call every bank. Like, I think for one of our refinances in Florida, it took us like 16 lenders to find the refinance for those hotels. And it was refinancing ultimately with bridge debt because we wanted to return capital to investors. So that's why I cautioned against it, because it made, at the sales, like, shoot, we got to sell it by this time. And it just provides, parameters that you don't necessarily want to have. So I've done it. That's why I caution against it. And just in general, like, hospitality, especially smaller hotels, can be hard to finance. And this is just where it takes you as that hardworking investor to find a good option that works. Like, don't give up when you hear a no or 10 no's. Just keep calling. And in my experience, eventually you'll find one. Think, like we talked about, necessity breeds creativity and invention and opens up options that you didn't know were there. Maybe it was a referral partner, maybe it was a new lender in a different area at a regional bank rather than somebody in your local market. But just keep calling. The loans are out there, and as more people get into this space and becomes more known, your options are just going to increase. So each phase, whether it's purchase or refinance, has its nuance and different requirements, whether you're purchasing the property at the beginning or refinancing once the project is complete to take out your equity. And in the perfect world, you can get all of your money out when you refinance and then pay investors back, get them their principal, and get all of your money out. And then essentially have no risk and continue to operate the property and collect cash flow. But I'd say in today's market, like, the perfect Airbnb is hard to find, and you may have to find a way to make the numbers work, leaving some of the capital in the deal and not having that perfect Burr where you get all the principal back. That's where, based on your deal structure, having equity investors that are in for the long haul, continue to get a split of the deal for, over the hold period, is a good benefit. You just have to make sure that you have the cash flow to cover the increased debt if you're refinancing and continue to provide a good return to you and your investors. And the key with boutique hotels, like, just like anything in real estate, is to get a good deal first. Like, always focus on finding a good deal and then putting the financing in place that makes the most sense based on the deal. If you guys have any questions on financing, please reach out in the community, the Slack channel, and write it down for in the group sessions. And, like, I'm sure we'll be talking more about this as deals start to materialize. So much of it is deal dependent, but if you make yourself aware of all the options, you'll be able to match that best lending option to your specific deal.